Good morning, everyone. I welcome you all to the Commodities Weekly Roundup with me, Ravindra Rao from Kotak Securities. Commodities ended a mix to lower last week as markets played down supply risks associated with Russia-Ukraine fighting amid hopes of resolution, and also assessed impact of higher price on demand. Concerns about health of Chinese economy and monetary tightening by major central banks have also pressurized commodities. However, most of the commodities ended well off the lows. The US dollar index has been range bound and it noted a mixed trade last week, but ended lower, marking its first decline in 4 weeks. The US currency weakened amid the reduced safe haven demand and as bond yields came off highs post Fed decision. Coming to commodity specifics, precious metals in precious metals pack gold after hitting August 2020 highs early this month failed to sustain and has corrected sharply to briefly test the $1900 ounce per level. Gold has corrected as Russia-Ukraine talks reduced its safe haven appeal, while correction in commodity prices reduced its appeal as an inflation hedge, while central banks continued with the monetary tightening to control inflation. ETF inflows, however, showed a continuing buying interest. There are still factors which could keep a floor to prices. Russia-Ukraine talks have been going on, but there has not been much headway. If talks continue without much progress, market confidence may wane again. Central banks are continuing with their monetary tightening steps to control inflation. However, all major central banks have acknowledged risks associated with Russia-Ukraine and may not take any aggressive move. Fed is projecting 6 more rate hikes this year. However, it is expected to move gradually. Also, its GDP growth downward revision shows risks to the economic growth. Going ahead, gold may remain volatile this week as market players assess geopolitical situation, virus situation, central bank stance, and Chinese economic health. However, market uncertainty may increase its safe haven appeal and keep prices supported near 1900 ounce level. On the technical front, gold seems to have taken support near 1900 levels, which was the breakout zone of August 2011, and it seems like price is holding that level very well. Now, if that level is held, then there is a great chance that gold might once again move towards 1970 $1980 and further higher. So that remains a crucial level. In case of MCX around 51,100 51,000 levels remains to be the support, and if that holds, we might see MCX gold moving higher towards 52,500 to 52,600 this week. In case of silver, also we have seen a good support at lower levels, and in case of MCX, silver price has taken a good support near 67,200. There is a good technical formation in silver, wherein the price reached the trendline resistance in the early part of March, and then we saw a throwback towards the breakout level, and now again it is taking support near the breakout level and it is moving higher. So until 67,000, 66,800 holds on the lower side, it might move higher, and there is a possibility it might once again move towards 70,000 levels. So both gold and silver as of now for this week looks slightly positive, but the Fed comments this week will have to be looked at to take a cue. That might trigger some volatility, but otherwise on charts it is looking slightly on the positive side. Coming to energies, WTI crude has witnessed a swift recovery of around 19% from the lows after correcting nearly 28% from the highs, which had brought a pause in rally since the start of the year. EU's decision to not ban Russian energy exports has eased supply concerns. However, if tensions do not de-escalate soon, global leaders may take more measures to pressurize Russia and energy exports could be revived. A talk to resolve Russia-Ukraine issue is a positive development. However, we need to see if there is any major resolution, and that too it should happen soon. Crude may continue to remain supported by concerns about lack of any replacement for Russian supply. OPEC has so far refrained from diverting from their gradual production hike stance. Iran's nuclear talks remain inconclusive, while attack in Middle East has added to the supply risk. US crude stocks are already below average levels, while emergency stocks are near 2002 lows, so we may not see much stock release. While supply risks relating to Russia may continue to be key price determining factor, focus will also be on the development relating to virus situation and Chinese economic health. Overall, crude sharp rise has made it vulnerable to profit taking. However, a sustained decline may not materialize unless Russia-Ukraine issues are resolved. We may see continued volatility as market players assess demand supply risks. On the chart, crude WTI crude looks to take resistance near dollar 115 116 per barrel. Currently, it is trading close to 112.5 dollars per barrel. And if that is held, then we might see some kind of a corrective move. But if 115 $116 is taken out on a closing basis, then we might once again see crude prices going higher towards 120 and above. On the MCX, 8700 remains to be a stiff resistance, and if that is taken out, it might once again try to reach 9000 and plus. And on the lower side, 7800 remains to be a strong support. If that is taken out, we might see crude further moving lower. So we expect a broad range between 7800 to 8700 this week, and volatility may persist. In case of natural gas is still trading in a broad range, but it is very close to a trend line break, and if that happens, we might see a sharp upside in prices. In case of MCX, 405 remains to be a stiff resistance. If that is taken out, we might see a sharp rally in natural gas prices, so we need to wait for that. But till then, 350 remains to be a good support, and until that holds, the prices may trade with slight positive bias. Any dips might attract buying, and on the higher side, look out for a breakout above 405 for a big directional move. Finally, coming to base metals, last week LME base metals traded on a mixed note as fresh wave of COVID-19 in China sparked fears of economic slowdown, while increased hopes of stimulus and lingering supply tightness concerns provided a cushion. This week, metals may continue to be volatile as situation remains uncertain between Ukraine and Russia. Besides, trader will closely watch flash manufacturing and services PMI figures from major global economies, as it may give earlier hints on the economic activity in March. This week, copper may witness some upside on hopes of stimulus package from China for the ailing real estate. Also, sharp decline in LME and Shanghai stocks may be supportive. On the technical front, there is an inverse head and shoulder developing in copper, and if 820 on the MCX is taken out on a sustaining basis, then we might see a sharp up move in copper prices. So wait for that break for taking a short-term view. To conclude, focus on development relating to Russia-Ukraine is expected to continue unless there are concrete efforts to resolve the issue. Risk sentiment may remain shaky while supply risks for commodity may persist. With Fed starting its monetary tightening cycle, market players may also focus on comments from Fed officials, including Fed chairman, to gauge how quickly the central bank may act going ahead. Comments from other central bank officials may also be on the focus to get more clarity about the future monetary policy stance, owing to increasing geopolitical risks. On the data front, focus this week will be on manufacturing and services PMI from Europe and US, which will reflect upon health of economy in light if rising inflationary pressures and geopolitical risks. Volatility is expected to continue this week. So trade with strict stop losses, and better to stay intraday because of the uncertainties. Good luck and trade safe.